When you hear the word recession, do you immediately think of a giant housing market crash? You're not alone. In this video, I'm going to go over the data that we have so we can discuss whether the coming recession, which we all know we're going to have, is going to cause a housing market crash or not. I hear from people all the time that they're waiting for the housing market to crash before they buy a house. And with all the chatter that's going on around lately with inflation and everything and all the expectations of a recession, I think people are assuming this will happen sooner rather than later. After all, according to Fortune magazine, from 2003 to the first quarter of 2007, housing prices went up 38% right before the Great Recession. And we've seen prices in San Diego go up that much in just the last year. Surely this isn't sustainable and prices will have to drop. After seeing what happened in 2008, it's not a stretch to think that we would see the same result today. And it's true, we probably are going into a recession at some point in the not too distant future. I mean, we've got really high inflation and the Fed is doing everything they can to bring that down. But here's the thing. We were in a recession in 2020 also, and prices accelerated. Yep, you may not have thought about that, but that's exactly what happened. Let's start with what a recession is. So a recession is a drop in the GDP, gross domestic product, for at least 2 quarters in a row. Now, understandably, everyone immediately goes to the Great Recession of 2007, 2008. But not all recessions are like that. In fact, according to Bankrate, in the past 6 recessions, prices have gone up in all of them except the one in 2008, which was caused by the housing market. That being said, those are national numbers and housing markets are local. So for example, in the 1990s, we actually saw housing prices go down in California quite a bit because the defense industry was leaving the market. So is it possible that housing prices could go down in the next recession? Sure. I don't have a crystal ball. I can't predict the future. Anything is possible. But let's look at the data to see what's most likely. Let's start with the doom and gloom. In 2019, Redfin released a report where they estimated the areas of the country that were most likely to experience a housing downturn. San Diego was high up on that list with a 68.2% chance of experiencing a downturn. Well, we know what happened. Instead, prices accelerated and went crazy up. So does that mean we're even more likely to experience a downturn? Maybe. But Moodys recently released a very similar study, and now San Diego's chance of housing prices going down is only 29%. It's a really big change. So let's look at some of the things that might be driving that. This is primarily driven by a lack of homes on the market here in San Diego. You can see in this chart what's happened over the last 10 years and just how low inventory levels are. Part of the reason for this is that after the Great Recession, builders stopped building. They got burned hard. And so they have been building way fewer homes in the past decade than they had in all the previous decades. In fact, we are now 4 million homes short of what we should be at had they continued the same building levels. Another thing that's driving the housing market is that's different than 2008 is that back then it was so easy to get a mortgage. Like literally you just had to show that you were alive. They didn't check anything. They didn't check credit or income or anything at all. So anybody could get a mortgage. So people who couldn't really afford the mortgages were getting them. People were using adjustable rate mortgages, very short-term ones, assuming their housing prices were going to go up. When everything crashed and the housing prices did not go up, they were now stuck. They had a way higher mortgage payment, but they couldn't sell their home. Today, the average homeowner has $307,000 in equity, and around 40% of all homes are owned free and clear, which makes the chances of another foreclosure boom pretty unlikely. But wait, what about all those people who went into foreclosure during the pandemic? Aren't they all going to end up on the market? Only 1.1% of all mortgages are in the forbearance process right now. In California, during the Great Recession, over 5% of mortgages were in forbearance. That is a very large difference. So between the incredibly low number of homes that we have on the market today, the tighter lending standards that we have that are actually keeping demand lower, the incredible equity positions that most homeowners are in, while we're probably going to go into a recession, the chances of a housing crash are very low. So we're definitely not expecting to see a housing crash. Will we see prices change? Yes. Instead of going up by 20 and 30% per year, they're going to be going up at a much slower pace. So we're expecting to see 3 to 5% over the next few years. So much, much lower. It will actually feel almost flat. And that means that there might be pockets where prices are dropping a little bit, but there's going to be other pockets where they're still going up a little faster, and it's all going to average out. And that's all going to happen because demand is going down drastically with interest rates rising. But we also might see supply either stay low or even go a little lower. Sellers have really great interest rates right now. They have no incentive to sell and then get a higher rate. Also, if we are in a recession, people are more likely to stay put so as to keep their housing payment steady and at least have control over that one aspect of their lives. I'm curious what your thoughts are this. Have you heard anything different than what I've covered? Comment below and let me know. And if you're wondering if you should buy now or wait for all this craziness to pass, check out my video on exactly that topic.